Hello friends, in this video we are going to discuss about an important bias which is called disposition effect. Now as you have already gone through a title of our video, this is a very important bias which keep all our individual investor in a poor state of investment. Before discussing about disposition effect in detail, let us see what successful investors portfolio looks like. When we say about Mr. Warren Buffett, you can see that three or four stock will contribute more than 50% gain and rest of the stock will give him small returns. Now, to do this kind of investing, you can see he have hold on to his winner. Okay, you can see Coca-Cola is still there in his portfolio, Apple is there. Okay, it has given a very good return. Now to do this kind of activity you need to ride winners. Okay, now why I am talking about him in general, because if you see, in a long term, if we want to generate wealth or if we want to generate good return, we need to have strong counters in our portfolio which you can ride on, which you do not sell after they have gone up, let us say by 100% or 200%. Now, as a retail investor ourselves, what we usually do is, let us take an example of ITC. If it is not moving, what we do? We either sell or wait for our price to come, wait for our cost price to come, and then we will sell that stock, citing that it is not moving for for the past 1 year. That's why I have sold that. On the other hand, you can take an example of Yes Bank. It has gone down. Let us say you have bought at 400, or let us say you have bought at 100, then it went down till 10. You have also applied FPO at 11 rupees, and your average is near about coming 30 rupees. And you are still holding that investment. Whereas in the first case, when you were holding ITC, you exited because it was doing nothing or it was near your price. Now, this selling can be triggered from various external factor. Okay, one of the factor might be you might be going out. Okay, you might want to travel any destination and you was in need of some money. What you did is basically you look into your investment portfolio and you decided that okay, this XYZ stock is giving me certain return, let me book that first, and the other stock which is which is giving me negative return, I will hold on to that. Okay, now this kind of behavior we generally do in our investment journey, and this behavior is nothing but it is due to the disposition effect bias. If we see, because of this bias, we try to book our profit fast. So what we do is we sell our winners and we hold on the losing counter. In our example, like ITC, or you can take any other stock. Okay, in the present time, you can say most of you might be frustrated with Reliance. Okay, but you will be happily holding Idea Vodafone. Okay, Vodafone Idea. You won't be having any pain holding your loser counter, but you might be thinking, okay, this counter have not given any return. Reliance counter have not given any return. When it come to my cost, I will exit. This disposition effect, okay, can be understood by various reasoning given by many experts. Okay, I will discuss few of them. One of the reasoning why we do or why we show this kind of behavior is because of we are having a reference price in our mind. Okay, so to take an example, you are buying Reliance at 2300, so this is your reference price. Now when it will go up, it moved to 2500, okay, or let us say 2600. At that time, you will show risk averse tendency. What does it means? Basically, you will try to lock in that gain, because in your mind you will say, okay, I'm getting 300 rupees gain, let me book. Now why you will book? I've said one of the reason that you might want to go out, okay, and you might be short of some fund. Here you can sell this counter and you can get some fund, or reason can be something else. In the same scenario, if that counter went down till 2000, okay, 300 rupees down, and you were in need of money, what you will do is you will not sell Reliance at that time, because your reference price is 2300 and now it has gone down at 2000 rupees. What you will do is, here you will show risk seeking behavior. Why? Because you will tell yourself, okay, this might go up till 2300 at my price, I might get, at that level, I might postpone the sale of this counter, and you will look onto some other profit giving counter. This is one of the reason, okay, because of reference point, because of basically your behavior toward the losses, don't want to cut the loss first. Now moving towards second reason, which is mean reverting, okay. Now we all know that market is mean reverting in nature, and we have seen in the past that market do have a mean reverting tendency. So when a stock is going up, there is a fear in our mind that it will again go down. And when a stock is going down, you will say that it will ultimately go up. Now, this kind of reasoning you give to yourself by seeing various example in the market. But in the case of, let us say, top losers in previous 4 to 5 years, which we have seen, you can say Yes Bank, you can say Vodafone Idea, you can say DHFL, you can say some other companies as well, which have shut, which have shut their shop. In all those cases, you were simply waiting to revert to their averages. Now, I'm not saying that mean reverting is not good in the market. It is a strategy, okay? It is a proper trading strategy, and you need to follow accordingly. But when we want to book something, okay, when we want to reshuffle our portfolio, we ideally end up booking our gains first, and then we will, in India, most of us, we like to average our losers, okay. Now another point which is quite relevant here is, we all want to be right, we all want to show our positive result to our friends and to our family members. Booking a loss gives us a mental pain as well. It gives us a feeling of loser, whereas booking profit gives us the feeling of being correct. Now, because of this ego, what we do is we end up, always try to book our counter very early, so that we can say ourselves that what I've done is right, and the counter which could have given further very good return end up giving you a very nominal return for your investment. Due to this reason, we show disposition effect bias in our behavior. Now to overcome this, okay, now we know the problem, okay, we know that whenever we do investments, okay, and by the way, this also apply in trading as well. If you're doing intraday trading and if you're holding three counter, okay, you're holding three position at the same time, to manage a risk, what we do, we try to cut our winning position first and then focus on the losing one. Okay, rather than cutting losing one first at minimal risk and letting the winning position further go up. Okay, so this is the thing which is very relevant for investment as well as in trading. In trading, the time frame is small. Investment, the time frame is big. So it is relevant for both the cases. Now, how to overcome this bias? There is a term called broad framing. It generally means that instead of looking your problem, okay, in a myopic way, in a focused way, you should look through the bird's eye view, or you can say you should see the broader picture. So if we recollect our example, we were facing shortage of fund for the trip. Now, this is a problem. For that, a normal investor might find solution in booking its gainers. Now, when you have invested in that particular script, you are having some thesis for your investment. You might be looking at its valuation, or you might be looking at some parameters. Now, valid reason to sell that investment would be change in underlying fundamentals. Okay, or if you are trading, change in underlying indicators or your patterns, or a simple trend reversal. But because of this problem, you were just looking to solve your current problem of shortage of fund. What you did is you sold your winner, or you can say you sold your winning stock. Now, if you have looked this issue from a broader perspective, you might have understood that I have made an investment for a reason and my thesis is still intact. I would rather wait for, I would rather wait to book that winner stock. In this scenario, instead of booking your winners, you must have booked your losers. Basically, you are not touching losers because of disposition effect bias, and you are just cutting your winners. And because of this, in the end, you will get poor investment result. Similarly, in terms of trading, if you are doing positional trading, what you are doing is a counter giving you 10% return, and it is not giving any indication of trend reversal. Still, you will book that counter, and a counter which stop loss should have been hit, you are telling yourself, you're convincing that okay, I will skip this stop loss, I will wait for some time, and ultimately you will become investor in that particular counter. So next time, whenever you have a problem, okay, um, or whenever you think that the solution for that problem is to sell a winner stock, you need to rework at that. I hope this video is helpful. Do hit the like button if you are liking our content and finding it valuable, and please hit the subscribe button if you are new to our channel. So till then, take care, and we will meet you in the next video.